Hello, this is the video for Chapter 7, which is the valuation of corporations and stock. There are three major learning objectives in this chapter. One is the features of common stock. Second are the valuation methods, which are free cash flow, dividend discount model, and market multiples. Finally, we'll look at preferred stock and how to reflect that in our valuation models. The comic strip for this chapter is today's share prices fell sharply on the fear that share prices might fall sharply. This is what I believe happens in news desks that are trying to make sense of the stock markets. Is they have a piece of paper. If the stock market goes up, they read these things such as the bullish mood of investors, or if it goes down, it could be the bearish mood of investors or profit taking, right? You hear these things all the time. So listen to the financial reporters and you'll see that they have some generic responses for whether the market goes up or down. So this should look fairly familiar, particularly the top blue box. And it's the value of operations equals free cash flow divided by 1 plus weighted average cost of capital. Notice the word here is value of operations. And this is to distinguish it from the entire entity. A company has many things beyond its operations. It has non-operating assets, which are like stock portfolios. They park their money in while they're considering their use of funds for growth. And they have non-operating liabilities, which are basically debt. Finally, in addition to common stock, they may have preferred stock. So these are the three adjustments we have to make to the value of operations. And that's why this refinement on what you've seen before. On the very bottom is what we call the dividend discount model, where we do valuation from the standpoint of what cash is received by the shareholders. And those are, of course, dividends. So looking at common stock and why it might be slightly different from company to company. Some things are typical of all common stock. The owners of the company own the common stock. They then hire boards of directors to represent their interests. The board of directors in turn hire management to run the company. So common stock is where the authority and voting power resides. Now there are some variations on that. First, it would be classified stock, where there may be different voting rights for one class versus another. And these classified stock would have special provisions. There's a reason for those to have different classes of stock. So the provisions in the stockholder agreement will show exactly what those differences are. We will look at Google, which is a kind of a famous example of how to use classified stock in a moment. Tracking stock. Tracking stock is even more complex in that the company has a major division and it wants to retain control of all its operations plus this major line of business. So rather than sell it, it then creates a tracking stock for that major subsidiary. And the owners of those, it is publicly traded, but the owners of those don't own that subsidiary. They own a portion of the rights that the parent has in that subsidiary. And an example of this is when Dell Computer made a major acquisition of EMC. It didn't have full liquidity in order to make that acquisition, so it created a tracking stock for VMC's most valuable asset, which is VMware. So Dell created a way for it to give not only normal consideration, but they could give these shares of a tracking stock, which gave owners some comfort because VMware is one of the most successful companies and in the Valley, and therefore had quite a bit of market value. So that's an example of a tracking stock where a major company creates a new company which has kind of beneficial rights but not direct ownership rights to that company. All right, let's look at Google and what happened there. Going way back to pre-IPO days, Sergey Brin and Larry Page started the company and they owned most of the stock. And they really didn't need much outside capital to grow the company. It was a quick success story. The IPO was in 2004, and they went public with two types of stock, A and B, Class A and Class B. Class B were reserved for the founders. They got 10 votes per share of Class B. Then what they sold was Class A, which had 1 vote per share. Therefore, the founders, by virtue of their superior voting rights in Class B, were able to retain the voting power at the board and shareholder level. Then there was a stock split in 2014. So yet another class of stock was created, Class C. But these were even worse. They had no voting rights. So now A had a 1 vote per share, B had 10 votes per share reserved for the founders, and then C had no voting shares. And that was the third type of stock. So the bottom line for this very unique company is that the founders were able to retain their control throughout multiple rounds of financing and through much market success, obviously, by having Class A with 1 vote per share, Class B, their class of 10 votes per share, and Class C with 0 votes per share. Again, is not normally available to founders. Most founders don't have such power or such an attractive company as is Google.